Okay, there has been some questions this past week about Very Good Food Company. Actually, I should say some concerns more than questions. But there is a question, and that is why has Very Good Food Company decided to dilute its shares? And if you're a follower of Jeremy of Financial Education, as I am, he was very upset about this past week. And, this video is not meant to throw shade on Jeremy whatsoever. I am a huge fan. I owe a lot to him. There are stocks that I would have never been exposed to had he not talked about them on his channel. But I really think that this is an instance where he's really not following his own advice by really looking at the fundamentals of things. So let's look at that a little bit. So we're just going to throw in the ticker symbol for Very Good Food Company, which is VGCF, or I'm sorry, VGFC. Okay. All right. So if you just do a Google search for VGFC stock, it's going to pull up, um, their performance lately, which has not been very good. If we look over the past 6 months, it's pretty much just been down, down, down. Actually, if you look at year to date, it has pretty much been down, down, down. Looked like there was going to be a little bit of a recovery happening over here. But then after it was announced that they were going to be diluting shares, it plummeted. And that's when Jeremy made his video really, really talking about how upset he is and questioning management. And he really made it sound like the management for Very Good Food Company was going to dilute the shares needlessly, but that's really not the case. So let's kind of look at financials and see why it is that they had to dilute shares. So this is the most recent quarter that's shown here. If you kind of go back to September 2020, you can see the revenue is almost 1.4 million, but they were losing 4.5 million that quarter, and they had a little over 8 million cash on hand. Looks like the next quarter, December 2020, they did raise some money, so their cash on hand did go up significantly to 25 million. But again, revenue, which did grow quarter over quarter, they were at almost 1.4. They grew to 1.8. But what also grew is the amount of money they actually lost for the quarter. Fast forward another quarter, you can see again revenue grew a little bit, but the net income, which was actually a net loss, grew by significantly more. So they were losing $15 million this quarter when they only had revenue of 2.6 million. Take a look at their cash here. Their cash on hand, March 2021, they had about 17 million available. Now let's go to the most recent quarter of info that's available, and you can see 2.7 million in revenue. They lost 12.5 million, which is a little bit better than the 15.3 million that they lost the previous quarter, but still 12.5 million in losses when you're not even doing 3 million in revenue. That's not a good ratio. And then look at how much money they have left. They only have, about 6 million left. Well, if they lost over 12 million in the most recent quarter and they only have about 6 million left, that means they're about to run out of money. So that right there gives you a pretty good indication of why they decided to offer out more shares and, subsequently dilute um, the value of the current shares. They didn't have a choice. Okay, this is something that they had to do. They were about to run out of money, and when you look at public companies, this is how they take care of getting out of this type of jam. When they're about to run out of money, they issue more shares. That's just kind of how it works. Now, what does that say about the very good food company and whether it's a smart investment or not? Well, that's kind of, that's really up to you. I can tell you my opinion, which is that this company may end up being a beast. It may, but the jury's still out, and it's going to be out for a while. As I said, when you're talking about a company that in the most recent quarter that's listed here hasn't even made 3 million in revenue, but they've lost 12.5 million, that's not that's not great news. And when you look back at the previous quarters and you see a similar story happening, that's also a little bit worrisome. That doesn't mean that the company isn't going to survive or isn't going to thrive. It just means that they have yet to really turn the corner and provide some evidence or provide a little bit of a track record that they're about to get to profitability anytime soon. In fact, it just seems like they are going to continue to hemorrhage money for the foreseeable future. So, me personally, this seems like a company that I would probably stay away from, not because I think it's going to fail, but because it's still too early in its development yet. I want to see a company that isn't necessarily profitable, but looks like it's gaining momentum from quarter to quarter towards profitability. And I'm just not seeing that yet in very good food companies. So I think I'm going to be staying away from this one for at least a little while.